Hey everyone, and welcome to the Inside Stuff. I'm Sean. We're a group of like-minded individuals, and I'm going to be distilling down the most important financial information on the web that you need to be paying attention to this week. Now, this is the week of the 28th, December 28th, 2015, so this is live, and we're going to be going through some stuff, and you need to be paying attention to this stuff because it is the end of the year, and we're all starting 2016, and we're trying to get on this path of, New Year's resolutions and getting on the right track financially. So the question I have for you today is, what is your financial goal for 2016, and how are you prepared to achieve that goal? Before I forget, don't forget, if you want a download of all of these articles for free, go to theinsidestuff.org. That's theinsidestuff.org. Go to our free stuff section, and you can download all these articles for free. Okay, let's jump into it. Okay, the first article that we're going to look at is entitled, "The SEC Considers Changing Accredited Investor Requirements." This is interesting to me. Remember that being an accredited investor gives you special privileges and allows you to invest in things that are outside of the marketplace, that are outside of Wall Street and outside of these high-frequency trading platforms. They're not paper assets. They're real, physical, tangible assets, okay? In fact, we have a strategy where we can show you how to jailbreak your IRA, your 401k, or any qualified government-qualified account, and invest in physical assets like gold and silver, oil and gas, real estate, whatever it is you want to invest in, whatever your wheelhouse is. So you don't have to go to your Fidelity advisor and diversify your portfolio that way. You can jailbreak that money, take it out, and have checkbook access and control over the money and invest it however you want. Having said that, SEC is thinking of changing the accredited standards for financial standards. All right, they've increased it because of inflation. They want you to have $1 million. The current thresholds are $200,000 individual income, $300,000 joint, or $1 million net worth. All right. What they want to do is bump it up to $500,000 a year for individuals, $750,000 for joint, and $2.5 million net worth. Minimum investments are at $750,000, and so it's going to make a big problem. The recommended thresholds in 2018 and 2022 are even higher. Okay, so the problem is that the SEC accredited investor definition has not kept up with inflation. That's another way of them saying, hey, you know what? We need to revise the rules of the game so that we can control your money more. We don't want you to invest outside of the market. We want to prop the market up and keep these bankers happy, keep these stock jockeys paid. So you need to stay in your 401k. We don't want you investing in oil and gas. We don't want you investing in gold and silver, real estate, other private notes, things like that. Okay. If you've ever done a private note between yourself and another person, you are considered an accredited investor because you have the expertise and the investment knowledge and savvy to be able to invest in real deals. So if you have any questions, go to theinsidestuff.org. That's theinsidestuff.org. Download these articles and get in touch with us so that we can talk. All right. Second article was really interesting to me. This comes from Bloomberg Business, and it's the year in review for 2015. And what we are going to focus on is these huge mega mergers, billion-dollar venture capital deals, and the record highs and lows of the market. Okay, so one of the record highs this year was Apple. Apple hit a record high of $775 billion in market capitalization. Now look at this. This is at the beginning of the year, 2015. This is where we are today. Do you believe that Apple Computer is worth less today than it was at the beginning of the year? Do you honestly believe that that's true? Because in order for a stock to be valued, there are two things that they look at. They look at the price of the stock in comparison to the earnings ratio. Earnings are being skewed now because the Fed is printing free money, giving it to these corporations, and they're buying other companies through mergers and acquisitions, And in doing so, they're counting those new companies' earnings as their own. So even the stock valuations that you see today are fake because the E is wrong in the PE ratio. All right. Netflix was the biggest performer in the S&P 500. Why do you think that is? Well, Netflix got a bunch of free money printed by the Fed, and they purchased a lot of assets, basically. So their stock price was up over 143% because they were including those other assets in their earnings, even though they got them for free. All right. Sales of investment-grade corporate bonds reached an all-time high. This was interesting to me. Most of you who have corporate bonds or any kind of bond think that you're safe in the market because it's a consistent income or a dividend or a rate of return. Real income, real money, real dividends are being paid and added to your total balance. Well, the problem is that those corporate bonds are a sham. Again, corporate bonds are just debt that's been issued by you, the investor, through your Fidelity account or your Schwab account or whatever brokerage account you're invested in. All right. Now, you may be diversified, and the safety mechanism that they use is to buy more bonds for safety. But the problem is that those corporations are so debt laden, and these corporate bonds that you're buying today are simply replacing old debt. And in order for that old debt to be satisfied, they have to make more money. If they don't, they default on the bond, or they restructure their debt through reissuing more bonds and just restructuring that debt. $1.3 trillion of money has gone into those bonds. Where did that money come from? You guessed it. The Fed printed free money. All right, junk bond market posted its first loss since 2008. Gee, I wonder why. Maybe it's because they couldn't pay back the debt that they owed before, and they were asking for more debt to restructure, and nobody wanted to do it. Mergers and acquisition deals topped $4 trillion. Think about that. In 2008, after the collapse, after the crash, we printed $4 trillion to save the market. This year alone, companies acquired other companies for earnings to the tune of $4 trillion. Where did they get that money? Where did that money come from? Did they earn that money and then take their earnings and buy those companies? No. They got 0% interest, free money from the Fed to acquire those companies. And again, when you acquire a company, you add the earnings to your book, which is fudging the numbers, making your stock valuation look much more appealing. There were more mega mergers, $1.6 trillion. $1.6 trillion. Let me say it again. 1.6 trillion with a T. Mergers that were over $10 billion than ever before. Why is that? Well, again, central banks around the world are printing money like crazy and allowing corporations to borrow that money at 0% interest. What we're seeing is that foreign entities, foreign corporations from Japan, China, and Europe are actually buying Western corporations. They're buying Western assets that are earning good money, earning good income, because their corporations aren't. So all of this money, this 1.6 trillion that went into mergers and acquisitions of other companies in America, is all fake printed money. Pfizer is buying Allergan for $183 billion. Think about this, all right? $183 billion is almost exactly what it cost us to pay the interest expense on our current federal debt. If you go to usdebtclock.org, you can see the current debt is over $18 trillion. Well, we're at a 0.25% interest rate on that money from the Fed. The Fed funds rate is 0.25, a quarter of a percent. If it is 1%, then you're talking $183 billion in interest expense. That's not even touching the principal balance of the debt, by the way. All right. So again, where did Pfizer get this money? You guessed it, printed from the Fed. Blackstone announced more acquisitions than anyone else, 47 acquisitions. Where did they get the money for it? Printed from the Fed. The value of IPOs was the lowest since 2009. Interesting. So companies are coming out, selling stock in an initial public offering to you, the stockholder, and nobody's buying them. Why is that? Well, how much are those companies worth? Is Facebook really worth what it's valued at today? I don't think so. I think it has potential to be, but today, no. And then equity offerings, stock offerings exceeded $1 trillion, which is a new record. So trillions, we've gotten off the B word, billions. Now we're talking about trillions everywhere. Vulture Capital Investments jumped a record 39% to an all-time high, $109 billion. Where did these vulture capitalists get that money? That's right, free money from the Fed, printed. And they made a record $6 billion in those deals. So just ridiculous amounts of money that are being thrown around here. And for you and I, that's for the wealthy people. That's for the wealthy corporations, the CEOs, the banksters, the Wall Street gangsters. For you and I, all we got to see were more and more job cuts. There were more job cuts announced this last year than any other since 2009, since after the collapse. Okay, 855,000 jobs were lost. Now, these are full-time jobs with benefits. So a lot of that could have been the reason, could have been because of Obamacare, corporations just wanting to get out of that program. So they're cutting your job from a full-time position to a part-time position just so they don't have to pay health care. Okay? 5 companies accounted for more than half of the announced layoffs. You can see them here. Again, go to theinsidestuff.org and download all of these articles for free. That's theinsidestuff.org. And you can download all of these articles and read them for yourself. This was interesting to me too. Millennials prefer life insurance to retirement benefits. Say it again. Millennials prefer life insurance to retirement benefits. Why is that? Well, seems to me millennials are a lot more financially savvy than our parents and our grandparents were. Corporations back in the 60s, 70s, and even the early 80s, over 90% of all corporations had some kind of defined benefit program for their employees, meaning if you put in your hard work and labor for however long and you're retired, they would guarantee your income for life to the tune of a big percentage of your salary through a pension program or some kind of defined benefit program. All right? Today, less than 10% of all corporations have some kind of retirement program or defined benefit program that guarantees income for life. All right? Now, millennials are smart, and they understand life insurance and the benefits that go with life insurance. One of the key benefits to life insurance is that it sets you up to create your own private pension program where you can generate guaranteed income for life. Let me say that again. Guaranteed income for life. What does the word guaranteed mean to you? All right? Next article. Meanwhile, over at the New York Stock Exchange, even more lasers. What? Even more lasers? Well, typically the way the New York Stock Exchange works is that when you place an order for a stock, it's keyed in or typed in manually by hand, and then that information is sent by a microwave tower to the company and recorded with the company. All right? But a new device has quietly appeared. Look at this thing. What is it? What is that thing? It's a laser. Well, the device, explained in early 14, is the Intellimax laser it's been used in various U.S. defense programs. Now, it's been generously provided by Innova to various and very wealthy high-frequency trading clients. Think about this. The guys that do the high-frequency trading platforms that basically make thousands and thousands of algorithmic stock trades per minute. Think about that. If you want to buy a particular stock and you place an order, this laser beam is going to beat you to that order, and they're going to do something with it. They're either going to undercut you and buy it cheaper or drive the stock price down by short selling it. All right? What does that do to your wealth? What does that do to your portfolio? How does this stuff affect your life, your real income and your real world life? Now, I've got this on YouTube. I wanted you to see it real quickly just to see what it does.
The origins of Intellimax were derived from Aoptic's defense lasercom systems. This advanced technology provided 10 gigabits per second ground-to-air and air-to-air wireless
10
transport
gigabytes
over
per
distances
second.
to 200 kilometers. Leveraging these developments, Intellimax offers a major breakthrough in wireless rate and reach, offering 6 times more channel capacity than microwave technology and 2 times more distance than millimeter wave. These products can be used on any tower or rooftop platform and require minimal linear space.
All right,
This
what's the
unique
point here?
solution
Well, the point is that you need to get out of the market. If you have your wealth and your savings and your retirement accounts in the market, we need to jailbreak those accounts immediately, get them out, and get them into real physical assets, things that you can control and that will generate real income or real returns and not be manipulated by these high-frequency trading platforms that are now using laser beams to enter in their trades. All right? It's getting crazier and crazier. Okay, here's another one that caught my eye. Even the big banks now admit that this is how the Fed's massive manipulation broke the market. So the market is broken. That's the first realization. Broke the market. Big banks now admit that the market is broken. How much of your wealth is tied up in the stock market? Get it out now. I don't know how to emphasize that enough. But central banks' risk manipulation well explains the local tales. And here's what's going on. Essentially, central banks are unfairly inflating asset prices, and they've compressed the risk like a spring to unfairly tight levels. All right? So they're increasing the stock price and decreasing the risk level by tightening and winding and cranking down this problem that we have, this trap that we have called ZIRP. How are they doing this? Well, they're essentially doing this by printing 0% money, giving money away for free. That money has to find a home somewhere. And so what it does is it finds a home in stocks and bonds and all kinds of paper assets, which get artificially inflated over time. So again, the question is, how much of your retirement savings or your wealth or your savings in general for the future is involved in this massive manipulation of the Fed and all of the central bankers around the world? Okay? And then the last article I have is Affordable Care Plans Carry Added Costs. You know, a lot of people believe that with Obamacare, their premiums go down. And that was the original game plan, was decrease premiums, yearly premiums for medical insurance across the board. Well, what's happening is that more and more physicians are carrying higher and higher out-of-pocket expenses. And so a lot of these plans, for some of them, they're paying a smaller deductible, but their out-of-pocket expense has skyrocketed. And so it comes down to either paying their deductible or paying rent. So they've stopped paying their insurance premiums again, killing the Obamacare program, and started coming back to free medical clinics for health care. All right? Again, go to theinsidestuff.org, download all of these articles, read them, and get familiar with what's happening globally and how it's affecting your own personal economy and your own wealth. All right? Again, this is Sean. Thanks so much for joining us at theinsidestuff.org, and we'll be talking to you next week. Have a great one.